all. My name is Hariharan, and I shall be the host for today's webinar on Arbitrage Fund by Axis Mutual Fund. Let me initiate today's webinar with a very short story. Mahesh goes to the nearby vegetable store to buy tomatoes. The cost of tomatoes there is 45 rupees per kg. He comes to know that approximately 1 kilometer from this place, there is a market where tomatoes are available at 40 rupees per kg. So Mahesh thinks of an idea. He thinks that if he can travel to that market, which is 1 kilometer away, and buy tomatoes at 40 rupees and sell those tomatoes in his local market at 45, he can make a profit of 5 rupees. Sounds cool, isn't it? Well, what is the risk in this transaction? Perhaps there is none. There is only a travel cost that is involved. Now, why did Mahesh get this idea? He got this idea because he found that the same item, which is tomatoes in this case, was priced differently in the two markets. And this presented him with an opportunity to earn 5 rupees per kg. This opportunity is what we call as arbitrage. But do such opportunities exist in the equity markets? The answer is yes. The arbitrage fund category has been a favorite category of investors in India. And over the last 7 months, we have seen average inflows of about 6,000 crores happening in this fund. To tell us more about the arbitrage fund and how investors can participate in this opportunity, we have with us Mr. Raghav Iyengar from Axis Mutual Fund. Raghav is the President and Chief Business Officer at Axis Mutual Fund, and he brings with him a very rich experience spanning over 25 years. Mr. Raghav will take us through the arbitrage funds and importantly will guide us into how we can take advantage of this fund to park our surplus money and earn a decent return. With that, over to you, Mr. Raghav.
Good evening, everyone. I hope I'm audible. There's a quick check.
Yes, you are.
Hari? Yes, thank you so much. Hari, I think your example was so spot on. I think the only risk in that whole transaction is two things. I think the price has to be 45 rupees when the gentleman gets it back. And then, of course, there is a challenge that if he doesn't sell it, that the tomatoes don't stay fresh forever. He'll have to throw it out. But yes, I think today arbitrage is nothing but a difference of price between two markets, right? And this is something that our grandmothers have been doing since time immemorial. Even today, I live in Bombay. If you get up early in the morning and you go to a place called Dadar, which is in the central part of Bombay, and you reach there by 5:36 in the morning, the price of vegetables are about 30% lower than what you would pay at the same time, and maybe in the same day, at about 9:30, 10 in the morning. This is how a lot of vegetable vendors actually do their business. So if you have the time and more importantly, the inclination and the storage space, and more importantly, the ability to consume it, that's it used to be a Sunday morning ritual for us when we were kids that my dad would take us all the way to the other. We would load up our Fiat car with vegetables. We are a large family. We get it back and then spend half of Sunday trying to sort the stuff out, make sure that it's in the right place, it's getting refrigerated, cut, whatever. So it used to be a great family bonding time. So in some sense, that's my first experience of arbitrage. We've got a brief presentation for all of you, not very long. Most people are not aware, but this is a very useful, lovely category for your surplus cash. I think it has some inherent advantages. It also has some potholes, which I think sometimes maybe many investors don't know about. So let's quickly dive into this category. We have a brief presentation for you, and after which I think many of you have posted questions already based on the invites that we've sent out. And Hari has actually sort of collated some of those questions, and we'll get to the Q&A part also as quick as possible. So again, my sincere thanks for all of you to come in this afternoon. I know it's a working day; it's in the middle of the week, so let's just get going. Hari, can we go to the next slide, please? So I think this is very interesting, I think, because the markets are markets, right? I think everyone thinks that the markets are very efficient creatures. That's what Keynesian economic law teaches us, but they are very inefficient. So what happens is that you have pricing differences across various markets, right? And what arbitrage funds try and do is to try and take advantage of this pricing, right? And by simultaneously, this is interesting because you're buying in one market, selling in another market at a slight difference, right? And largely, where are these differences? In India, for example, in the equity markets, they are largely between what we call the cash market, which is what you see on TV every day. There is also something called the derivatives market, which is what we call the futures and options market. And there are many securities, for example, which are in the F&O segment, what we call the futures and options segment, and in the cash segment. Their prices keep moving. Now, why do they move? Because obviously demand supply. If you get a huge block of shares to sell in the cash market, it does affect the price. Immediately, maybe you could have economic circumstances, results of companies, results of sector, maybe something's happening on a political level. Prices keep fluctuating around, right? And one way to sort of tap into those prices is to either do it through cash, where effectively you're essentially paying for that money, the entire money, the purchase of securities immediately within the payment cycle, or F&O, where you have an ability to uh, pay a small part as what we call margin and pay the balance as a sort of a loan that you're getting there. So these are the two big things. I think interestingly, India is possibly the largest F&O market in the world. I think very few people know that. All of you know that we are maybe the fifth largest market cap in the world. That is, that in the Indian stock markets recently crossed a magical figure of $4 trillion, right? In terms of market cap. Market cap is nothing but the prices of the securities into the number of companies, into the number of shares that are listed in the exchange. Recently, we crossed a very, very big firm, a big mark called the $4 trillion. But arbitrage or the F&O market is actually many, many times that. And it's also made up of all kinds of investors. So as like both the markets, you have a mixture of retail, institutional, FIIs, everybody participates in both the markets, right? So typically, this is largely what happens, and this is what the basic definition of arbitrage. Yeah, next slide, please. So I think importantly, there are some terms, and I'm sure many of you have heard of these terms, but the spot price is the current price of a stock. Very easy to figure out. You go today at 2:30, you type out the price of, let's say, HDFC Bank, get a price over there, right? Futures price is also run on the same exchange, but in a different, it's run in the NSE, but in a different segment. Is the price of the futures contract of that same underlying stock. So you can go out and say, I want to know what is the futures contract price of, let's say, HDFC Bank for, let's say, December maturity or January maturity. You will get a number there. Expiry day is the day when this contract expires. Every contract expires. Typically, this is on the largest monthly contracts expire on the last working Thursday of the month. So many of you will understand why there is sometimes volatility in the month end. This could be one reason. The spread is obviously a very easy definition. That is the difference between the spot price and the future price. And the margin is what are the funds which are held as collateral for taking care of those derivative contracts. Like I said, you can go out and buy futures, you can buy options. By not putting the entire amount, you can pay a margin and you can pay up. The rest of it can be actually, you can, is sort of fund. And the funds are held as collateral. So you don't need to, if you want to buy, for example, 100 rupees of stock, you can put a margin, and the margin keeps changing depending on the type of stock, the liquidity, the volatility. And this is something that the exchanges do very, very efficiently, very well. And that margin keeps changing on a daily basis. So these are some of the key things there. Very importantly, I think this is the convergence of price. And if you see what happens, you have a difference, the futures and the spot. And that's why you have arbitrage funds which come in and sort of take advantage of both of these things. And over a period of time, especially as I said, typically in the expiry days when those prices actually converge. So effectively on the day of the expiry day, you will have the futures price and the spot price being pretty much the same, right? Next, please. Hari. This is a beautiful slide which talks about how this works, right? If you see, there is the gray line is the future price, the red line is the spot price. As you can see, there are small differences. In fact, in many cases, people will not be able to spot the difference. They are sometimes in decimal points. But those decimal points are beautiful arbitrage opportunities. And then again, if you see what happens on the expiry date, the red line and the gray line actually converge out. Now you'll be thinking, what is this 1060, 1100? This is nothing but the chart of the price movement. And you can see the price movement, it largely synchronizes with the cash price. So you will never have a cash price, which is say 1000 rupees and the futures price, which is 1100. That kind of movement will not be there. A very low volatility. So typically what is that determines that difference? I think we'll talk about that later separately. But as you can see, the spread just sort of went up and down. And more importantly, And why that spread goes up and down is something also that I'll try and explain to you in the next 5 minutes. But if you go and look at it from day 1 to day 15 or day 20, the expiry date, you will see that the spread becomes effectively zero. That's typically the day of settlement, as I mentioned on the last reporting Thursday of the month, right? Next, please. So this is how it works. I think it's very simple. You buy stock at 100 rupees, you sell the stock at 101. So let's say the price goes to 105, and this is the reason why people buy. So someone who's bought it at the price of 101 has actually made a 4 rupee profit. But does it affect you or me? Is it a loss? No. We have made our 1 rupee, which is that we made a gain on our cash position of 5 rupees. We made a loss on our future position of 4 rupees because we are buying and selling it simultaneously. When the price is the same, both are 100, but you have already deprived it at 101 in the future. So again, it's 1 rupee. Now, this is the last one is what most people get worried about. Hey, suppose the stock price comes down, then what happens? Because people see, oops, I bought something at 100 rupees. 1 month later, it's gone down to 95. So what happens to that loss? Actually, no, because you made a gain on the future, right? Because you have sold the future at 101. So the 101 minus 95 is 6, and the loss on the cash is 5. So again, it's the same. So what this tends to do, an arbitrage transaction tends to try and capture profits across all types of trading activity, even in rising, static, and obviously when it falls, right? Next, please. So why arbitrage funds? I think this is very easy. I would go to straight away point number 3 because I think they are hedged. You're not keeping what is called an open position. You're doing the trade simultaneously. Very difficult to do, not impossible to do given the technology that we have, but very difficult to sort of immediately manage it in a retail position. But there are some very, very smart, astute investors. You see them in a lot of the social media platforms. But I think institutional wise, because we run very large AUMs and very large long only assets, Axis, for example, runs over 170,000 crores of equity and hybrid funds today. So I think importantly, we have some expertise in that, and obviously it completely hedges your portfolio out, right? Because you're buying it and selling it at the same time, right? You have various trading strategies by which you can enhance returns without compromising on the risk, right? And then more importantly, I think there is a mismatch in price between two exchanges. That's the fundamental nature of arbitrage. And these funds try and take advantage of those mismatches in price and try to deliver returns to you. All this, what does it give you? It gives you a great package of a balance of safety. Because as I showed you in the previous slide, irrespective of market conditions, whether your cash price has gone up, down, or static, you made your return. It was also very liquid because most of these funds give you money back in 2 days. As I told you, we have the largest F&O market in the world. We are the fifth largest market cap in the world. So we are very, very liquid in both the exchanges, both the F&O exchange as well as the cash markets. There's a huge amount of liquidity available. So it gives you a great balance of all safety and returns, obviously, and of course, liquidity, right? Next one. Now, this is an interesting thing which most people are not aware of. So I'm going to spend 5 minutes, a couple of minutes on this. I think, as you know, capital gains taxation is a little complex, right? Now, most of us, and there are two types of investors as an individual or a HUF investor. There are domestic companies, and of course, there are non-resident companies, right? Now, if you look at capital gains on specified mutual funds, which is anything but an equity-oriented fund, typically you get charged at your rate of tax. So suppose I'm paying a 30% tax rate as an individual. If I were to go and sell my debt mutual fund or any fund which has less than 65% in equity, I'll end up paying something like 30%. Anything less than, sorry, 35% in equity, I'll end up spending about 30% in tax. Same thing for a company. Companies, you have two types. You have 30%, 25%. New companies, there are three, four different tax rates depending on which company you fall in, bracket you fall into. And of course, any other non-resident investors also, you will pay that same rate of tax. Now, of course, there's another element of tax which has got done now, which is if you have between 36 and 65% of equity, your long-term capital gains comes down to 20%, provided you hold for a minimum period of 3 years from the date of investment or the date of allotment. The last one, which is very interesting, is an equity-oriented fund where your long-term capital gains, that is, number one, it's not 36 months, it's 12 months. So anything beyond a year from your date of allotment, you hold it, you get taxed at the rate of 10%. right? Number two, you also have uh, in terms of that applies to all investors, right? Interestingly, for short-term capital, now this is very interesting because if you even hold it for 3 months or 6 months, typically you will end up paying only 15%. Now, as I told you, arbitrage funds are treated as equity funds from a taxation perspective. So you got a very interesting idea, which gives you a blend of safety, obviously gives you liquidity, and then more importantly, also gives you decent return at a post-tax return because you are being charged at 10 and 15% respectively for long and short. Your post-tax returns are much better or much higher than what you would get in maybe traditional savings instruments, right? So this is a very big advantage that you have by investing in an arbitrage fund because they are treated as equity funds. If you go and look at portfolios, you will find a minimum of 65% being kept in equity, the balance in debt and other instruments for liquidity and margin purposes. Yeah. Next, please. So what's the strategy here? I think you have to exploit the cost of carry. It is basically you have these four strategies. This is the price of cost of carry is nothing but the interest rate and the price differentials between the cash and the stock. The scheme tries to do both together, right? So it is no unhedged means that I don't buy cash and leave the. So I'm not taking a market call here. I'm not taking a stock call. If I go and buy and sell a particular stock at the same time, I'm not being bullish, bearish on the price. I'm just trying to capture the difference between the price in the FNO market and the cash market, right? So that is called an unhedged position. That's a hedged position. If you were to buy a normal equity fund, we take a position based on our research on where we believe the company is going. There the price can go up and down. It reflects in the NAV, right? Whereas here, because you're buying and selling at the same time, you are no unhedged, right? So I think the risk would be if, let's say, that nothing happens in the market, you're trying to dilute the equity risk. Now, so you will tell me where the risk is. I think will come. My hope is somebody asked us, a lot of people asked us that question in the Q&A, so I'll try and cover it there. And we use debt mutual funds because this will be between 65 and 75% of the portfolio will be this whole arbitrage strategy. You have to keep it at 65% because otherwise it becomes, like I said, a debt mutual fund. So typically, most mutual funds keep it at 65 plus uh, and keep going higher depending on what is the view in the market. And the remaining is kept in debt, very high quality debt paper or debt mutual funds, which gives a much better efficient of execution and also gives you what we call a higher interest rate for the rest of the portfolio, right? Yeah, next. So today, if I were to look at Axis AMC, what's our story? I think we typically have about 18 to 19 odd 18 odd percent in debt, cash, and other receivables. This debt portfolio is very liquid portfolios because, as I said, this is largely used by investors for short-term parking as well as for one-year parking. This money, we don't typically buy long-dated paper here. Long-dated means anything over 3, 4, 5 years. You look at the type of investments, you will see very high quality names over here. Government securities, PSU, bank, certificate of deposits, and highly rated NBFC certificates of commercial paper over there. The other side, we keep a little bit of money in mutual funds. This is used for the margin. As I told you, when you want to take an FNO position, you have to put a margin. These are used for margin. These are also typically very high quality funds where at least 80-85% money is in the highest rated instruments, the Axis Money Market Fund and the Axis Ultra Short Term Fund. And the hedged equity portion is about 70%. Typically, that doesn't go below 65. Now, interestingly, it goes through, this is a very diversified portfolio. There's no concentration because, as I said, you have to keep finding opportunities very rapidly, lock in the return, and then just stay there, right? So today we have a portfolio of almost 125 issuers where positions are taken both in cash and in the FNO market, right? Next, please. So I think the important thing is where has the arbitrage market worked? This is interesting because the participation in arbitrage has seen a huge amount of improvement, right? So today you're looking at every month the portfolio rolls. So if you look at roll spreads, that is the spread between cash and FNO is about 62 basis points. Now, what does this mean? It means that if you were to get 62 for the next 1 year, say from November 23, December to December 24, your portfolio will make for that 65, 70%, 62 into 12, which is roughly about 7.3, 7.4%. Now also remember the 30, 35% is also in debt. It's also in low duration debt. So that's also giving you a pretty good return because interest rates, as you know, have gone up a bit. So I think very importantly, it's also how do these spreads get calculated? Why is it 60 and not 20? It is largely because of the market sentiment, right? I think very importantly, if you see bullish sentiments, which is what we've been experiencing, especially for the last 5, 6 months, you will see the spreads being quite aggressive. There have been periods of time, let's say if I were to go back and look at April 2020 was an aberration. We just had the COVID pandemic, lockdown, lots of uncertainty in the market. Arbitrage spreads had actually come down practically to zero at that point of time. So that's the risk that depending on the bullish, bearish mood of the market, it is also in some senses visualize that this is the cost that people are paying to participate, to buy, to leverage in the market. So obviously when market is bullish, people, investors are happy to pay a little more interest. And that's where the spreads at times kind of go up. But when sentiments are bearish, when there is uncertainty, when there are issues, you will also see the reverse happening where there is no demand and hence obviously the spreads come down, right? So typically the roll trajectory has been very, very strong. That means even though market has moved up quite substantially, and Hari spoke about this, this has been one of the highest selling categories in mutual funds in this financial year from April onwards. Uh, Despite that, typically when we have seen our experiences that when a lot of money comes in, the rolls or the spreads, as we call it, keeps coming down. It's a natural law of demand and supply. More money comes in, obviously the rate of interest comes down. But I think this year has been a bit different because I think it's been strong throughout because of the fact that I think there's been a bullish sentiment, and at least in the near term, that sentiment seems to be continuing. Right? Next, please, Hari. So I think it's important to understand a few things before you can think of investing. Right? I think to our mind in Axis AMC, one thing that we keep trying and we keep trying to re-emphasize and emphasize again and again is that a knowledgeable investor is a ideal investor. Because if you know what you're getting into, then you will participate wholeheartedly. You won't just test waters, you will put in the maximum amount of money that you are comfortable putting. But if somebody is just dabbling, then that may not be the right thing because then your experience can be very different, right? So I think importantly, this slide is critical for people who have never done arbitrage, but you have to understand these positions are very absolutely hedged. So effectively, the fund is not taking any open market equity exposure, right? When there is huge volatility, you will find that the returns profile tends to go up and down. So when there's a lot of trading environment, like I said, a lot of bullishness, you will find a fair amount of return coming, right? When can this fund give you, can it give you negative returns? Because I've said that it's hedged. Of course it can. If you try and take out money or if you are pulling out money before the expiry, right? Then there is a chance that because the spread between cash and futures is not converging, there is a possibility that you could have a loss in your portfolio, right? But if you complete an entire cycle, so typically, ideally, if you invest and redeem money around the FINO expiry cycle, which is typically the last week of every month, the chances of you getting a negative return are not very high because of the fact that the fluctuations come much, much lower at that time. So ideally, what should you be bear? How long do you need to participate? Like I told you, if you keep money for over a year, investment returns, I mean, your returns are taxed at 10%. But if you keep it less than a year also, ideally even it's only 15%. So ideally, many people, in fact, even investors try and say, hey, can I put money in for this for a month? No, I think ideally because you will need to see a few cycles like I talked about, right? So ideally, my preferred investment horizon is 6 months plus, right? And I don't know, we put a 3 to 6 months, but I would rather say that 6 months, and then of course you can keep it for as long as you want, as long as the rolls are happening in a manner which is giving good return. I think the money can be kept for a long period of time. We have investors who have kept money for a year plus also, 2 years also in arbitrage funds. How can you participate? Very easily. I mean, like a normal equity fund, you can come in via the lump sum or via SIP also. So I have a very senior colleague, for example, who's putting money into arbitrage as a SIP. So I asked him, I said, aren't you doing this? I mean, SIPs are normally kept for equity, right? Because that's how you participate in the market. He said, no, 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 I have a short-term need which I need to fulfill in November 24. So I can't put this into a fund, an equity fund, for example, because one doesn't know where returns are. But here in this product, your ability to predict returns is much, much higher. The certainty of return is slightly higher. And obviously the risk levels are much lower because of the hedged position. So it doesn't have any lock-in. But typically, you have what is called an exit loan. Let's say in the Axis Arbitrage Fund, if you take out before 15 days, is an exit loan that will be charged to you. But yeah, technically, you can put in money today and take it out next week, and there's going to be no charge. As in, we don't have a lock-in saying that you have to keep money for 1 month or 3 months or 6 months. That's not the case. But the ideal investment horizon in my opinion, is at least 6 months plus, because then you will get a couple of investment cycles. And of course, one needs to also keep checking the bullishness of the market and get a sense as to how much the spreads are. That all this information is available in the fact sheet if you look at it. Yeah, next please. So yeah, this is the product labeling. As you can see, more importantly, in the riskometer, which is something which all of you should look at, because riskometer effectively tells you what is the scheme risk. Risk profiler, we did a lovely campaign recently, an invest education campaign called Socha Samjha Risk. So there, I think the idea was to try and get investors to do their own risk profiler, which will tell you, give you an indication of whether you are willing to take risk and how much loss are you willing to consider. And it's a lot of psychology involved, because and these are very personalized decisions. There is no one size fits all. Just because I'm young doesn't mean I can put 90% in equity. Just because I'm old doesn't mean I can't put higher money in equity. It's very, very individual. And marry that risk profiler to obviously your riskometer, which is in the fund. This is what I said. The riskometer in the arbitrage fund, both in the index as well as the fund, is low, which means that the principal is at low risk, right? But very importantly, I think this is a product which you must have in your product suite. It has seen a huge amount of flow. As I said, the post-tax returns, because of the fact that it's considered to be an equity fund, is much, much lower than other mutual fund products which are available today for its level of risk. So I hope I've been able to add some value through the last 8, 10 slides. Hari, how do you want to take this? Yeah.
Yeah, thanks. I think it was a short and a crisp presentation. We got some questions, which had come to us. So let me just quickly take some of these questions.
Right.
So first question is, an investor asked a very interesting question. Most of these schemes are delivering returns, with a difference of only about 30, 40 bips.
Yeah.
And therefore the question is, what are the factors that one must consider, before one selects an arbitrage fund?
I think more importantly, any fund, not only an arbitrage fund, Hari, my view is that point-to-point returns sometimes tend to be a bit misleading, because you don't know your start point, you don't know the economic value at that. So whether it's an arbitrage fund or a debt fund or even an equity fund, the preferred way I would look at measuring performance is by using something called rolling returns. As you know, that gives you slightly more higher data points. So when you look at rolling returns, I think the consistency in rolling returns is important. Not who's first and who's second, who's third. If you've been able to consistently be around a certain level, that sort of gives me as an investor comfort that the investment return is predictable. I will be worried if investments in 1 month are X and then suddenly they fall and then they go up, they go down. That can happen obviously in equity or equity oriented or hybrid oriented funds. But in an arbitrage fund, you should not have too much variability in returns. So rolling returns and low variability are the two big criteria I would put it. And please give higher marks for that rather than trying to select who's number one, number two, number three, right?
Sure, thanks.
The other one, of course, which is a bit debatable is obviously, and there are large arbitrage funds available in the market. It's not that it's not the largest fund in this category is, I think, over 20,000 crores in size. But typically, the smaller the fund or the ideal fund is in the, say, sub 10,000 crore range. It's easy for the fund manager to maneuver, because as I had mentioned, you have to buy and sell simultaneously. So obviously, size sometimes becomes a problem. But so far, that's not an issue so far, because as I said, the sentiment this year has been very bullish and contracts are getting easily executed. Yes.
Sure, thanks. You talked about the taxation bit, and therefore one of the questions that has come up is, what is the tax advantage that an arbitrage fund offers vis-a-vis somebody were to park the fund in maybe a short-term debt instrument or the debt mutual fund for that matter?
Yeah, so I think from April 1st this year, the debt taxation has changed. So as you know, earlier we used to have a 3-year long-term capital gains advantage that
Right.
that the Income Tax Act gave us. This year onwards, it is as good as any other debt instrument that you buy, a debt mutual fund. So whether it's a debt mutual fund or any of the other traditional debt instruments, you will land up paying tax at whatever is your marginal rate. So if I'm an investor paying 30% income tax on all my other investments, non-capital gains, I will pay 30% on the gains that I make. So if I have to explain it by an example, let's say you go and buy a corporate FD at 8% today, you pay after 1 year, you get 108 rupees. So 8 rupees is taxed at, let's say at my level, will be 30% plus a charge, which could be 33%, right? Assuming I make the same, instead of 8, I make 7 in an arbitrage fund and I hold it for more than a year, my 100 becomes 107. On that 7, I pay only 70 paisa tax plus surcharge. So maybe about another 10, 20 paisa. So instead of paying 8 minus, say, 2.4 or 2.5, which is about 5.5, you could land up getting about 6.1, 6.2.
Sure.
And you've not really diluted the safety element very much. Because as I said, you're simultaneously buying cash and futures. So your safety element is also not being compromised.
Yes. You talked about the benefits of arbitrage fund. Are there any risk in this fund?
Why, of course. As I said, you have to try and time your exits closer to the expiry date. Because if you try and take it out mid-month, there is a possibility that there could be a variation between the cash price and the futures price, which could give you what we call mark-to-market losses, like what happens in any other normal equity instrument.
Right.
So there is a potential possibility of capital loss, right? And I've seen this happening with investors who, just because something has a 15-day exit load, they come in for 15 days. Very difficult to predict 15-day return. Somebody comes in on December 1st and says, I want money on December 15th. I don't know the markets on December 15th, right? The other part is, of course, you have anywhere between 35% downwards being put into debt and instruments, right? So again, the quality of debt instruments are very, very critical. So if you go out, sometimes we have seen instances where people, to try and get that additional return, go a bit down the quality curve. If there's a problem in those instruments, that will obviously also affect the returns of the fund. Lastly, I think, yes, I think you have to be aware of that. This is a cycle. I mean, this is a bullish bear cycle happens many times in a year, right? So one should be very careful of looking at very near-term returns and putting, because you may be just getting it. So if you are looking at the last 3-month returns and saying, hey, I want to put some money and then try and project those returns ahead, might be not the best thing to do. I would suggest look at it over at least a 6-month plus kind of a cycle, which is where I said that ideally you should have a 6-month plus type of horizon to do. Having said that, nothing stops you from taking money. My only advice is try and time your purchase, and at least if not your purchase, at least your exit around the last week of the month. That will ensure that the volatility is at its minimum point in those periods of time. Right?
I think very interesting couple of points, which I want to reiterate. One is that you talked about the time horizon, because generally a lot of questions keep coming. Can I put the money for 1 day, 10 days, 15 days, 1 month? And it's very important because people generally sort of tend to extrapolate and say that, hey, this fund has delivered very good return in the last 1 month. Let me try and take an exposure for 1 month.
Yes.
It's very important for the benefit of all our investors, what Mr. Raghav has highlighted. Please ensure that your time horizon is at least 6 months, so that you get to look at the entire cycle of the investment, so that you are able to get a decent return on your investment. That's very important, right? One final question, you talked about the fact that market sentiments play an important role here.
Yes.
Today we are, and you also highlighted the fact that over the last few months we have seen very good stock market performance. We have also seen last 1 week, that FIFs have come back to India. So
Yes.
does this all augur well for these spreads, which you talked about, and therefore reasonably good expectation in terms of performance in arbitrage?
I think, Hari, largely this category also in some sense moves in sync with the short-term interest rates in the economy. Short-term interest rates are pretty good right now, actually, for savers. Maybe not for borrowers, but definitely for savers. So I think from a near-term perspective, I don't see any stress. Having said that, whenever there's a big deluge of money coming in, sometimes for a couple of months for the market to get adjusted, the rollovers tend to get a bit affected. So if let's say January first week, because typically that's the time when in the past where FIs have tended to reallocate their portfolios, right? And let's say they've invested, let's say $10 billion comes in the first 10 days of January, which is not impossible. It has happened in the past. You could see some movement in the rollover spreads. So suddenly maybe your January returns may look a little subdued compared to December. But if you allow this money to be digested over a period of time, maybe 3, 4, 5 months, you will find that depending on the bullishness in the market and the short-term interest rates and general market mood, it gets digested and then you start getting back to reasonably good levels of interest level trajectory. Which is where I'm quite clear that one should not do something very, very short term in this fund. I mean, ideally stay invested. This is a great place to keep your emergency corpus, great place to keep your near-term goal corpus, great place to keep money which you want to put in as an STP. Ideally, of course, but then your systematic out date, your withdrawal date should be the last week of the month, not in the middle, right? That's the only caveat I have. So this has a lot of uses in this fund, right? And if I overlay the favorable tax treatment that you get, especially compared to other instruments of this type, I think it's a win-win combination for all for investors concerned, right?
Absolutely. I think it was quite an insightful session on arbitrage, though it was a bit short, but I think all the relevant important points is what Laghav explained to us. I'm sure all our investors would definitely look at considering the Axis Arbitrage Fund to park their excess money, as Laghav just quickly talked about, emergency corpuses. And he also highlighted about one instance of his colleague, who's also done SIP in this fund to take care of this next 1 year goal. So all of these can be the use cases for this fund. I'm sure that all our investors will definitely look at this to achieve their objectives. To all the investors who have joined us today, a big thank you for attending the webinar. And we look forward to connecting with all of you in the future. Till then, I and on behalf of Axis Mutual Fund, we would want to wish you a Merry Christmas and a Happy New Year in advance. Enjoy the festivities and take care. Thank you all once again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Done, sir.
Thank you, Karthik.